Hello, and thank you for attending another episode of Napkin Numbers with Freeman Lunt. Today, we're going to be talking about the importance of bankability and how that can impact your business. First of all, the landscape, what you're dealing with. Three different types of banking institutions out there. You have your nationals, which are the big dogs of the industry, pretty much in almost every state, who have the full menu of products that any kind of company would look for. They're usually more geared toward your middle market to large corporate businesses, but they also help the small businesses too. They carry things like foreign exchange, merchant services, derivatives, treasury management. Some of these things may not matter to you, but they have the typical depository things that are needed for a business. Next are your regionals, which don't have as much geography covered as the nationals, obviously, but have a lot of the same products, but will be missing some of the more technical things like derivatives, probably the full-scale large treasury management platforms, and maybe even full-on portfolio management for loans. Lastly, credit unions. Those have a very limited menu of products, will typically need participation from other lending institutions to do loans anywhere from $1 million to $2 million or $3 million and above. They'll have loan limits in those ranges. They have loan committees that are going to be the ones making the decisions on approval or denial of loans. Sometimes you have to present to them. Sometimes credit people do on your behalf. But that is what you're dealing with out there. So depending on the size of your company, you're going to learn who is the better fit for you. And you can outgrow a bank. You might start with a credit union today, move into the regional tomorrow, and end with the national, obviously, if you get real big. Why does all this matter? Because you need to understand what bankability means and how some of these different groups are going to look at you and what types of banks you really are going to be a best fit for in regards to your lending needs. Scott's going to talk about how these banks will evaluate you from a risk standpoint.
Every bank's going to evaluate the risk a little bit different. For the most part, what you're going to find out there, you can Google this, you can talk to your banker, they're going to have some type of 4, 5, 6, 7 C's of credit. I think the ones that I've heard the most is the 5 C's of credit. And, that's character, it's collateral, capacity, capital, and conditions. And again, you can get in depth doing a quick Google search, but generally it's a framework for understanding how do I manage my risk as a bank around all of these different companies that come in. And the one that most people really focus on, it's the capacity part. And that's your financial ratios. That shouldn't be the only thing you look at, but that's the big thing for most business owners. They're also going to look at your growth, your ownership, how the performance of their particular loan portfolios are. But that financial ratio piece, we like to break it down into 3 different components, and that's leverage, liquidity, and coverage. And those 3 components tend to be things that are easily digestible as a business owner. You're like, oh yeah, that makes sense. And it's also something that if you get your arms around and you start to understand how a bank looks at you, it's so much easier to understand why you're going to get credit or why you're not, and what you have to do to improve. So, let's talk about the first one. So leverage, I think the part for most people is like, well, what does it mean? And there's different ways to calculate it, but the most common for Main Street or maybe the bottom end of lower middle market companies is taking your total liabilities and dividing it by your shareholder equity. So on a balance sheet, that's all of your debt divided by your equity, and they're usually right on top of each other in your balance sheet. So what that means is for every dollar you have in equity, you have X amount of dollars in debt. And for most banks, again, this is going to vary depending on your industry or the bank that you're using or the credit union. Whoever is going to give you money, they'll have some type of different metrics they use. But for the most part, 3 to 1 seems to be a pretty good metric. Another way to look at that is you have 3 parts of debt, 1 part of equity. If you're going to buy a house and you put 25% down on the house, that's the same ratio, if that helps. The next one that we like to talk about, you got leverage, now it's liquidity. And that's really about the money you have around and the debt that you have around for these next 12 months. So that time frame's pretty big, right? So the ratio there is your current assets, dividing it by your current liabilities. So that's your current ratio. You find that on your balance sheet too. And that's a measure of your ability to repay those obligations over the near term. So the ratio could be something like 2-to-1. And that would mean for every dollar that you have in current liabilities, you have $2 in current assets to pay that debt. Again, good is subjective. Talk to your banker for what works for them. But most of the time, if you're over 1.5-to-1, if you've got $1.50 in the bank for every dollar in a debt due in the next year, that's usually pretty good. The last one we're on, coverage. So this one can be a little bit tricky for some people. Well, actually for most people, it's because it's, well, how am I repaying debt? And when you start to think about how banks calculate it, I've seen some really complex different ways of adding and subtracting this, depending on your lender. But really, it kind of comes down to what's the money that you generate as a business. And another thing they'll look at, depending on your industry, is how much capital expenditures you have. So this is really about, on an annual basis, are you making enough money to pay the debt that you have or that you will have from the bank? So a really basic way to look at this is if you take your EBITDA, again, EBITDA, earnings before interest, taxes, depreciation, and amortization. Another quick Google search, it's all of your earnings and then taking away the leverage, that interest, adding back the taxes, because that can be different for every single person, every single business structure, and then those non-cash transactions of depreciation and amortization. So you take all that back, you've got this big lump of money, and you start to pay bills with it. And so the capital expenditures part could be something that comes into consideration if you're in, say, manufacturing, or you're in a business that has a lot of capital expenditures every year, like I'm buying a lot of trucks, because you will find that on your statement of cash flows, under cash flows from investing activities, it'll show, hey, I'm adding back all of this depreciation into my EBITDA, but actually every year I'm spending $100,000. So should I really be adding that back into my depreciation? And usually the answer is going to be no, because maybe your business model has this recurring cost or update to vehicles or whatever it is on an annual basis, and a lender is going to consider that. So when you take that EBITDA, subtract out your capital expenditures, that's going to give you a number. And for that, you divide it by the debt that you have or the debt you will have that you have to repay. And that ratio is your debt service coverage. And for that, it'll say, well, let's say 1.25-to-1. Most lenders like to use that figure. And what it says is for every dollar you have in debt that you have to pay, you make $1.25 in income, which you can do some reverse math. That's like 80%. So again, check with your banker. Every program is a little bit different. Every scenario is a little bit different. Every industry is a little bit different. But for the most part, that's what they're going to look at when it comes to coverage. So if you want to think about how to make your business a good risk when you're approaching your lender, it's one, understand those different things, that leverage, liquidity, and coverage. You want to have a strong balance sheet and income statement. You want to be able to articulate your business plan, make it easy to follow along. If you've got a company where the underwriter can't make heads or tails of what you're doing, how are they going to approve you for a loan? You also want to be transparent. Don't be afraid to communicate, talk to your banker. That's their job, is to listen and be your advocate, and have strong advisors. Have tax advisors, have legal advisors, have insurance advisors, have a round table of different people that are involved in your business, and be able to talk to them about what you're doing and where you want to get to, because they can help you with that banking request. And, I just want to kind of wrap this up, but, as you go through all of this stuff, you figure out all these numbers, you understand your banker, and you say, okay, my company looks good. But then there's all these common misunderstandings. So I want to let you guys know this is sometimes you'll see business owners go, okay, I'm not going to the bank. You know why? They don't help startups. Or if I run a lot of money through the bank, they're going to help me, which may not be the case. Or I have to show profit every single year, or they're not going to help me. Or I just have to have a lot of money in my bank account, or they're not going to lend to me. Talk to your banker. They are one of your most valuable advisors that you can have in your network, because they're the ones that help you with not just getting growth capital, but all of the other banking functions, treasury management to help your company run smoothly and securely on a daily basis.
Those 4 questions that you can ask your banker are: number 1, how does your bank evaluate my company from a lending perspective or risk? Number 2, how would you be an advocate for my business within your bank? Number 3, how would you fund my growth? And lastly, number 4, how have you successfully helped a business like mine? Those 4 questions are going to give you a good understanding of the banker you're dealing with and how they're going to help your business move forward. And that is the end of this episode. Thank you for joining us for another episode of Napkin Numbers.